When you look at the stock market in nominal terms, you can see that it has performed exceptionally well since March 2009. Look at the government-provided statistics for jobs, consumer sentiment, and prosperity, and you will see a grand disparity between all of this and reality. It doesn't make sense. Once we look at the hundreds and hundreds of indicators that have been piling up, we understand that beneath all of this is a rotten core. You came here for the truth, so let me unveil that for you. I have way too many charts to show you in one video, but let's begin. China's small banks relying on short-term capital to fund lending like Lehman and Northern Rock. And you can look back in the pages of history and quickly find out it didn't end up so good for these two companies. Equity money market asset ratio, this is the SPX being the black line, and the blue line is the equity money market asset ratio. You can see that there is a range of what you consider normal, but we have gone far beyond that into uncharted territory. It peaked over this level of excessive optimism twice before, but today it's gone into territory we've never seen before, right? So that right now should show us that there are different market cycles that occur, natural market forces. But today we have central bank intervention instead. The natural market forces are not present, and that gives us the realization that we have now lost that sense of reality, and it is in the hands of a few select people. They are all working together, all central banks globally, in a concerted effort to decide the prices of all of these different assets. All right. Mutual fund cash balances are at all-time lows of 3.3%. Look around the different fund companies and you will see a trend, and that is going towards more and more equities, right? They're going towards the equities. They are losing out on a lot of these money market funds and everything. Not that I'm suggesting one is better than the other, that's for sure. But they're going in that trend that's pushing the market up higher, of course. And I also see more and more leverage being used. There's a lot of margin that I believe will cause a very big problem in the near future. We can just look back in the pages of history to see every time this happens, it's right near the end of that bull market. It's not a good sign, despite what people believe. Just because the market is going higher, that's not a good sign that it will continue on. Look at this. Compare a company like GE. It's been around a very long time, soon to be delisted, and compare it to a company like Netflix, and you will see the difference. The price being one, but ultimately the interest in these two particular stocks, I mean, it has gone parabolic recently. Absolutely parabolic. Meanwhile, GE is being delisted. What about the revenue of these particular companies? You look at a company like Netflix, yes, they're getting new people coming in, new people signing up. Sure, that's great. What about the revenue? Are they creating as many jobs as a company like GE is? What is underlying all of this? Understand that there are times in which we see euphoria, and euphoria is never good. We need to see major retracements in stocks. We need to see major retracements in all asset classes. That's how you form a healthy bottom. Not the stock market dropping by 666 points and then just skyrocketing afterwards. That's not a retracement, okay? That's a blip. We don't want to see that. We want to see a new foundation being formed. PE ratios by market cap, February 2000 versus January 2018. All I wanted to show you here is that we can look at all the technical analysis and we can see that there are times in which PE ratios, different indicators out there that go from overvalued, that go from extreme into what we can say is ultimately something that we've never seen before. Comparing, the financial crisis to what we see today, we've gone past most indicators in every way, in the good and bad. And it seems like there's no end in sight. But when you look at the tech boom and bust, that was seen as to be, ridiculous, and things were so overvalued, nothing made sense, and everybody claims that they saw it coming. But today, we've gone far beyond that. Suddenly, everybody said, no, everything's fine, it's not the same. Well, it's a different situation, that's for sure, but too many indicators are popping up showing we've surpassed it. Now, I like to do this as much as I can, and that is to compare, instead of everything from the US dollar to something else, you can take certain assets or certain things and compare them to other things or assets. And this here is now, as of this time, it takes the average worker 129 hours to purchase the index level of the S&P. And you could see that, guess what? It's gone beyond what we saw during the financial crisis and during the tech boom and bust. 129 hours. That is the highest multiple of all time, exceeding the previous peak of 108 hours when the tech bubble was fully inflated in March 2000. So that is a comparison of the average person, how much they work, right? Average hourly earnings versus the S&P. It is not in nominal terms we are talking here. We're not just saying, okay, what is the S&P now and then are you factoring in inflation, or surely over time it would become higher and higher? That's what happens. No, we're talking about average hourly earnings versus the S&P. Gone far beyond that. Very quickly, these charts here, all I wanted to show was that right now, leverage is at an extremely high level. No matter where you look, we are seeing more and more leverage, and more people are willing to take on that risk of extra leverage. This has been allowed, of course, by the governments, where they have been relaxing all the lending standards. It's okay. Let them have less and less reserves on hand. It's not a big deal. There are certain even ETFs that will allow extreme leverage on them. You can basically say, look, I don't have enough money, but that's okay. I can just use margin. I can use leverage. I can use debt. And that unfortunately doesn't end well many times throughout history. Cash and stock holdings as a percentage of financial assets. Stocks make up the bulk of private sector holdings. Many people are not keeping cash on hand. They are investing. Why? Because they don't want to lose money. And they know that. So they keep pumping their money into this system. It's not a good thing, however. Not that I'm saying cash is a good thing. But ultimately, you put your funds into somebody else's hands and you hope that they will accumulate and accumulate. But there are periods of time in which that is not the best idea, and it's up to you what you want to do. I'm just noticing the trends and bringing them to you. Look at this. Greece versus the US 2-year government bond yield. All right. So we have this turmoil. Everybody's wondering what's going to happen to Greece. Will they get their bailout? I don't know. Are they going to get their bailout? Sure, they're going to get it. Okay. We see the ease in tension, right? And continuously sliding. So much so that when you compare it to the 2-year US yield, which is fairly stagnant but slowly climbing to the point where you're getting more than the Greek 2-year debt. Which one is presenting itself as reality? Or either? Which one is supposed to be more safe? Look, you're going to get more yield as things become more risky. So you invest in a market that is considered very risky if you want some yield, and if you want to just play it safe, you would invest in some of these AAA rated investments. Look, the company's rated B- for Greeks. B-. The same company rates the US at AAA. Now, is that fair? Does that make sense that you would see this death cross occurring? Doesn't make sense to me. This is the Anglo-American 2020 bond yield. I just wanted to show you the fact that it has really declined over time here. Moving on. Merrill Lynch's clients allocation to cash as a percentage of the assets under management is the lowest in over a decade. We also know of anecdotal evidence of large private banking teams with 1% of clients' money left in cash. Why would you leave it in cash, right? That's what they're thinking. There's no money in it. It's simply not a good idea. So I'll make my clients more money right now because the central banks are going to print. So we don't have to worry about stock market crises. Look at that. Look at where it has gone. When they want safety, they increase their cash holdings. Ultimately, they don't know how to properly invest, so they get into money market funds, and that's where it keeps more stable if you're willing to accept a devaluation of your currency over time. But anyway, it's really ultimately a joke when you see all of this. Many people are just giving up their money, put it with the different fund managers, and they hope for the best. Equities to bonds ratio is at a critical juncture right now. Both yields overtaking both dividend yields and CAPE earnings yields. You can see that for yourself right here. This crisscross action is not a good sign. Think about it. What has been happening is this intervention we've never seen before. How in the world are we ever going to get ourselves out of it? Oh, let's see. More intervention? Yeah. Well, that's ultimately what we are facing. Make sure you click on the link in the description to see part 2 of this video. We're not done yet.